If you're over 50 and living in Florida, or planning to move there, the 10 names about to appear in this video could help you avoid losing tens of thousands of dollars in the next 12 months. This isn't a rumor. It's not a prediction. It's real data already happening right in the middle of 2025. From Miami to Sarasota, rental prices in Florida are plunging by as much as 42%, a pace unseen even during the 2008 crash. And worse, many landlords don't know it or realize it far too late. If you're retired, living on fixed savings, or a renter looking for stability, those cities that once seemed ideal could trap you in skyrocketing costs, bad deals, or investments made at the wrong time. In this video, I'll reveal 10 Florida cities that are losing control of their rental markets, where landlords are panicking, selling off properties, and watching their cash flow vanish. Each city comes with real data, deep analysis, and clear warnings. Don't think this video is just for investors. If you're renting, planning to relocate, or simply want to know which places are worth living in and which ones to avoid, don't skip this. The next 10 minutes could save you from 10 years of regret. 10. Miami, the symbol of wealth, now the epicenter of panic. I'm losing nearly $2,000 a month just to keep my condo from being foreclosed. That's the bitter confession of an investor in Brickell, the downtown area once dubbed the Wall Street of the tropics. But that's no longer rare in Miami in 2025. The city that once drew investors like a gold rush is now crumbling day by day under the weight of a free-falling rental market, skyrocketing costs, and collapsing confidence. As of September 2025, reports from Zumper show that median rent in Miami dropped about 8% year over year, down to just over $3,000. Still expensive by national standards, but nowhere near enough to save landlords bleeding cash. While they scramble to fill units with every incentive imaginable, from free first months, $2,000 gift cards, and free parking, the vacancy rate keeps climbing. With nearly 20,000 new apartments built in just 2 years, the vacancy rate has surged to nearly 8%, a record high for Florida. The situation worsens as ownership costs skyrocket. On average, a condo here carries an insurance bill of more than $15,000 a year, 5 times the national average. Not to mention the maintenance and repair fees required by new regulations after the 2021 condo collapse. Some buildings, like 1060 Brickell, have been ordered to raise $21 million in repair funds, leaving residents and investors reeling as fees double overnight. And the final blow? Airbnb. Once the golden goose, short-term rentals are now suffering heavy losses as tourism weakens, with bookings plunging to just 40–50%. As a result, countless hosts are switching to long-term rentals or selling at a loss, flooding the traditional market with even more oversupply. Miami is no longer just a symbol of a collapsing market. It's a vivid reminder of the price paid for believing real estate could only go up. When even a paradise like Miami can't keep the investment dream alive, no city is truly safe. 9. Cape Coral. Why did a retirement paradise become the epicenter of crisis? How did a city once called a paradise for retirees turn into a financial nightmare in less than 3 years? Cape Coral, the coastal gem of western Florida, used to be a dream destination for retirees seeking peace, for investors chasing Airbnb profits, and for anyone dreaming of buying cheap, earning steady. But by 2025, everything has flipped beyond recognition. Average rent here has fallen nearly 8% from its peak, and many 3-bedroom homes sit on the market for weeks with no inquiries, even when priced around $800. The joy landlords once felt from steady cash flow has turned into a chilling silence of empty inboxes and blank showing calendars. Cape Coral is now drowning in the very oversupply left behind by the 2020-2022 boom. As of Q3 2025, more than 2,300 three-bedroom homes are listed for rent, about 400 of them under $2,000 a month, and still sitting vacant. Any listing above $2,000 is almost guaranteed to remain empty for months. Rental activity has slowed to a crawl, and a silent war among landlords has begun, lowering prices, offering incentives, covering utilities, anything to fill the rooms. But that's only the tip of the iceberg. The hidden part, the one silently bankrupting many investors, is the skyrocketing cost of ownership. Cape Coral sits right on the coast, so after recent hurricanes like Ian in 2022, insurance rates have soared. In some areas, home insurance premiums have doubled in just 18 months, and many companies have stopped issuing new policies altogether. With mortgage interest rates nearly doubling since 2021, anyone using leverage is being squeezed by prolonged negative cash flow. Rental profits now exist only on paper. In reality, landlords are losing money every single month. The Airbnb collapse is the final blow. During the 2020-2021 boom, hundreds flocked to Cape Coral, chasing quick profits from tourism. But by 2025, occupancy rates have plunged, nightly rates have dropped sharply, and short-term rental supply has far outpaced demand. The result is a wave of panic selling. More than 50% of listings in Cape Coral have already gone through at least one price cut. Home prices here have fallen an average of about 11% from their peak, with many owners accepting losses just to cut early before the damage gets worse. Cape Coral is no longer a place to settle or invest safely. It's a clear warning to anyone who once believed coastal real estate was a safe haven. When insurance costs soar, mortgage debt tightens, Airbnb implodes, and renters vanish. Even the warmest dreams can turn into heavy burdens. Have you ever thought about retiring in a place like Cape Coral? After watching this part, has your view changed? Share your thoughts in the comments, and don't forget to like and subscribe if you found these insights useful. 8. Orlando. From tourism paradise to the battlefield of Airbnb investors. 3 months without tenants, 2 months of free rent, and still, no one signs the lease. One landlord in Orlando vented on a real estate forum, and that's far from rare. What's unfolding in America's tourism capital is a shock unlike anything investors have seen. Who would have thought that a bustling place like Orlando, home to Disney, Universal, and millions of visitors each year, would become the epicenter of the 2025 rental market crisis? After the pandemic ended and tourism returned to normal, the Airbnb dream of thousands of Orlando investors suddenly lost its magic. Properties that once drew nightly bookings at high rates now sit vacant for months, as the market has become oversaturated. Hundreds of Airbnb units have been converted into long-term rentals, creating a supply wave the city has never seen before. Meanwhile, traditional long-term renters, students and remote workers, have declined significantly compared to lockdown years. Supply is surging while demand shrinks, leaving Orlando trapped in a painful squeeze with no way out. By mid-2025, median rent in Orlando had fallen 4 to 5% year over year, settling around $2,000. For luxury apartments once expected to generate strong cash flow, the drop is even steeper, some down as much as 20% from their peak. Many new developments now sit empty for 30, 60, even 90 days without a single tenant. The regional vacancy rate has doubled, from a typical 3 to 4% to nearly 8%, signaling a severe oversupply. Unable to withstand the pressure, landlords are competing through aggressive promotions, offering 1 to 2 months free rent, covering utilities, waiving deposits, or adding parking perks. Some buildings have even turned leasing offices into giveaway centers just to attract visitors. And for small individual landlords, competing with large real estate corporations is nearly impossible. Many are forced to slash rents deeply or invest more into upgrades and furnishings just to fill a unit. A local real estate blog put it best: incentives are back, creating a level of competition no one could have imagined a few years ago. Worse still, many investors who bought rental properties in Orlando during the 2022 boom are now facing severe negative cash flow. With high interest rates, rising operating costs, and falling rents, many can no longer stay afloat. The hold and wait mentality is fading fast, replaced by a wave of panic selling to cut losses. The number of listings from small landlords is surging, a clear sign that a retreat in fear has begun. What do you think about Orlando, once considered an Airbnb goldmine? Would you dare to invest here in 2025? Leave a comment, hit like and subscribe to keep receiving the most in-depth analysis of the U.S. housing market. 7. Fort Myers. When new buildings rise and tenants disappear. A question is haunting real estate investors across Fort Myers. Why can't I fill a brand new apartment in a neighborhood that's booming? The answer sends chills down many spines, because they're not the only ones desperately looking for tenants. Fort Myers, once the pride of Southwest Florida during the post-pandemic migration wave, is now facing one of the quietest yet most dangerous crises in the market. From 2021 to 2023, the city witnessed an unprecedented construction boom. Population surged, rents soared, and apartment complexes and new communities mushroomed everywhere. But by mid-2025, the market is suffocating under the weight of its own uncontrolled growth. In June 2025, within just 30 days, the number of three-bedroom homes listed for rent in Fort Myers jumped from 515 to 697, a 35% spike in a single month. That's not a sign of growth, but a warning bell. Supply has far outpaced real demand. Newly opened apartment buildings stand half empty. Entire blocks of new neighborhoods sit abandoned. One local expert compared today's Fort Myers to the grim days of 2008. Rents are inevitably adjusting. In 2025, the median apartment rent here fell to around $2,120, about 6% lower than in 2024. For larger or more suburban properties, the drop reached as much as 9%. But the scariest part isn't the numbers, it's the prolonged vacancies. Many landlords clinging to 2022 level prices now face 60 to 90 days of empty units. When the math is done, the losses from vacancy often outweigh the impact of cutting rent earlier. And in this picture, small investors who bought in 2022-2023 are taking the hardest hit. They purchased at peak prices, with high interest rates and blind faith that rents would keep climbing. Reality proved the opposite. Rents fell, loan rates stayed high, and coastal Florida insurance premiums doubled after Hurricane Ian. Add maintenance, repairs, and inflation eating away at every dollar of profit. And many landlords are now running negative cash flow each month, even with tenants in place. If they can't refinance, or if the market doesn't rebound soon, a wave of panic selling could sweep through Fort Myers in the second half of 2025. Fort Myers stands as a textbook lesson for one critical question. Does fast growth really mean sustainable growth? Share your thoughts, and don't forget to like and subscribe so you won't miss the next chapter in uncovering the truth behind the U.S. housing market. 6. Sarasota, the crash that stunned America. Who would believe that rent in a beach city like Sarasota could drop more than 40% in just 12 months? But that's exactly what's happening. And for thousands of landlords, this isn't just a number, it's a living nightmare. By mid-2025, Sarasota, the jewel of the Tampa Bay coast, made U.S. housing history with the steepest rental decline in the nation. According to reports from Stacker and House of Leon, average rent here plunged from $3,290 in early 2024 to just $1,886 in early 2025, a shocking 42.7% drop. Even though small sample data may exaggerate the margin, other sources like Zillow confirm the same trend. Sarasota's rents are falling fast and deep. The current median rent sits around $2,500, over $300 less than a year ago, roughly an 11% decline. For a market that once burned white-hot, this is a freefall that left the entire industry stunned. Why is this crash so brutal? The answer starts with two words: oversupply. During 2021-2022, Sarasota was a retirement and Airbnb paradise. Multifamily projects broke ground everywhere. The population surged, and rents soared out of control. But 2025 tells the opposite story. Demand has weakened sharply, while supply keeps flooding in. Just this year, the Sarasota-Bradenton area is expected to add 3,800 new apartments, the largest jump in over a decade. Meanwhile, the vacancy rate has hit 16.5%, the highest level in 25 years. One expert summed it up perfectly. From almost zero vacancies to streets full of "for rent" signs in just 2 years, this market didn't collapse overnight. It fractured from within. Behind the numbers lies an extremely fragile demographic structure. Sarasota has a high proportion of retirees, residents living on pensions and savings, unable to endure prolonged cost storms like insurance, healthcare, and food. When rents skyrocketed in 2021-2022, many seniors pulled out of the market, leaving Florida or moving back in with family. Now, while falling rents might draw some tenants back, the pace is too slow to match the surge of new developments flooding in. Finally, Florida's migration wave, once the lifeblood of this market, is cooling off. Without a steady influx of newcomers to prop it up, Sarasota has slipped into imbalance. A city once seen as stable and serene has become a symbol of volatility. It soared out of control, and now it's plunging without brakes. The dark side of paradise. Did Sarasota's crash surprise you? Share your thoughts below, and if you found this content valuable, don't forget to like and subscribe to explore the next cities now falling fast in the 2025 rental crisis. 5. Tampa. Once the fastest rising rental market in America, now forced to cut prices just to keep tenants. Tampa was hailed as the shining star of Central Florida during the 2021-2022 boom, with rents climbing at breakneck speed. But by mid-2025, the market has flipped. Median rent has dropped about 5% down to $2,100. Vacancy rates have climbed to 6.5 to 7%, compared to just 1.4% in 2022. It's a stark warning for every investor who once believed Tampa would stay forever stable. Amid fierce competition, Tampa landlords are pulling every trick to keep tenants. Rent discounts, 1 to 2 months free parking, upgraded amenities. Both large apartment complexes and individual landlords are making concessions. Incentives that used to appear only in major cities are now common in Tampa, a clear sign of shifting power in the market. But what's more worrying is the demographic trend. In 2024, net in-migration to Tampa was only about 10,500 people, a drop of more than 70% compared to 2023. Rising living costs, stagnant wages, and soaring insurance premiums are pushing many residents out of the city. When population growth stalls, rental demand follows, and that's when landlords start to panic. Do you think this correction is temporary or the beginning of a much larger sell-off? Share your thoughts below. 4. Naples. When the playground of the wealthy starts bleeding cash, you know the market has truly turned. Naples, Florida's capital of luxury living, was once nearly immune to rental volatility. But by 2025, the Airbnb saturation and belt-tightening among affluent travelers have changed the picture. Many villas and high-end condos now sit vacant for extended periods, forcing rents down, even by just a few percent. But for a market once seen as eternally stable, that's a warning sign. Even worse, ownership costs have exploded. Coastal home insurance in 2025 has skyrocketed. In some areas, it's doubled. Many landlords can no longer afford hurricane coverage. Meanwhile, property taxes and HOA fees have climbed along with home values. The result? Leveraged investors are suffering heavy losses as rent income fails to cover expenses. What was once a break-even rental expectation has turned into a monthly financial burden. Many are now retreating. According to Naples realtors, a wave of condos and villas listed for sale in 2025 are priced 10–15% below their peak. Investors who bought during the 2021–2022 frenzy are selling at a loss to stop the cash bleed. Naples, once a financial safe haven, now proves that no market is immune when profitability disappears. Do you think a high-end market like Naples will bounce back quickly? Or will the sell-off wave continue? Let's discuss in the comments below. 3. Jacksonville. Is Jacksonville really the last safe zone of Florida's rental market? Or is it simply falling more slowly? Compared to southern cities like Miami or Sarasota, Jacksonville, or Jax, appears to be less painful by mid-2025. Rents are down only about 2–3% year over year, and some neighborhoods are even holding steady. Thanks to its diversified economy, limited reliance on tourism, and ample land, Jax has avoided major shocks. But beneath that surface stability, cracks are spreading fast. From 2022 to 2023, investors poured into Jacksonville, driving home prices up nearly 40% in just 3 years. The once promised positive cash flow from rentals is now a harsh reality check. 7% interest rates, stagnant or declining rents, and shrinking margins. Those who financed their investments are now struggling to make payments, feeding their properties with personal cash each month just to stay afloat. New supply isn't lacking either. About 8,000 new apartments have been built over the past 2 years, mostly on the city's outskirts. This has kept rental prices stagnant, while intensifying competition between older and newer developments. Landlords in older neighborhoods are being forced to either cut prices or renovate just to retain tenants. Jacksonville hasn't collapsed yet, but it's shifting fast, from a landlord's market to a renter's market. Do you think Jacksonville can maintain its stability, or will it eventually fall into the same downward spiral as the rest of Florida? Share your thoughts in the comments below. 2. Hollywood caught between two giants, Miami and Fort Lauderdale? Can Hollywood still hold its ground? By 2025, the city is no longer the appealing stopover it once was. Average rents have plunged 9.5% year over year, one of the steepest drops in South Florida, second only to Hallandale. The reason? Simple but brutal. Once Miami began cutting prices and offering incentives, Hollywood had no choice but to follow, or lose renters. Tenants are now willing to drive farther if it means cheaper rent or a free extra month. Location advantage is no longer the armor it used to be. Even more worrying is Hollywood's ownership structure. Most rental properties are held by small individual landlords, not major corporations. When the market turns downward, they're the first to get hurt. Many listings sit vacant for months, forcing owners to sell. Several brokers report a growing wave of former rental homes now listed for sale with the note, "Can't sustain negative cash flow." It's a clear sign of localized panic spreading through the market. Hollywood also lacks the distinctive identity that other cities have. It's not a financial hub like Miami, nor a tourism powerhouse like Orlando. When rents fall across the region, Hollywood becomes the easiest place for renters to skip. And that's why a city once in the middle has now become one of the most vulnerable in this downturn cycle. What do you think? Can Hollywood hold on, or will it continue to fall deeper? Share your thoughts below. 1. Boca Raton. When the wealthy start to flee, you know the market has hit its limit. Boca Raton, once praised as the remote work haven for New York finance professionals, is reversing sharply. Rents in luxury high-rises that once skyrocketed during the pandemic are now plunging. With employees called back to the office and Florida's cost of living no longer cheap, migration inflows have dropped significantly. While the overall data shows only a slight rent decline, 5%, the luxury segment has fallen by more than 10%. High-end apartment projects completed after 2023 now face entire floors sitting empty. Many are offering free rent months, complimentary utilities, even celebrity promotions. Yet units remain vacant. Vacancy rates at some towers are estimated between 15 to 20%, a staggering number for a segment that once had waiting lists. Investors who bought at the peak with leverage are taking the hardest hit. With 7% interest rates, high insurance, and heavy taxes, negative monthly cash flow has become unbearable. Some have started listing condos for sale, accepting losses just to stop the financial bleeding. The combination of shrinking income and rising expenses has turned Boca Raton into a textbook case of an out-of-control luxury market. Do you think the high-end segment will recover quickly, or is this shock far from over? Share your thoughts below. In summary, 2025 is redrawing Florida's rental map. Cities once celebrated as retirement paradises or Airbnb havens are now witnessing plunging rents, empty apartments, and landlords bleeding money every month. The pain isn't limited to investors. It's spreading to renters, retirees, and anyone who believed in the Florida dream. If you're thinking about moving, buying, or investing, stay alert. Cheap doesn't always mean opportunity. Ask yourself, why is it cheap? Here's the practical advice for you. Always check real rental data, inventory levels, and ownership costs before making any decision. One wrong move now could cost you years to recover. And you? Which city surprised you the most today? Where are you living? And are you feeling these changes too? Share in the comments. I read every single one. And if you found this video useful, don't forget to subscribe, so you never miss honest, deep, and straightforward analyses like this. Florida is shifting. Don't be the last to know.